Um, Mechanical Technology, ticker symbol MKTY, is our next company. If you're looking for an undiscovered way to play the crypto and data center industry, this company is for you. The CEO, Michael Tipperack, also runs a private equity firm, and through that vehicle took a very large stake in the company and a few years back, and is executing on a very exciting growth strategy. We're honored to have Michael, the CEO and also the largest shareholder of the company, with us today. As a reminder, if you have any questions, please click the Q&A button at the bottom of the Zoom screen, enter them there, and we'll get to them after Michael's presentation. Michael, thanks for being with us.
Perfect. I'm going to share my screen, but first I wanted to thank you for having me. It's a privilege to talk to you guys. I know it's a select group of really smart investors that I'm really thrilled to continue to be a part of. That being said, I'm just going to dive right in. Legal disclosures, lots of pages on that. Listen, before we get into details of what I do, I want to hit a few points. You're here because you're looking for interesting investment opportunities. So there are a lot of good companies at this conference. My purpose in presenting this to you is to tell you about our company and why I think it's a compelling investment opportunity at today's valuations. First, I think if you do the math, you'll see that we're trading at a significant discount to most mining companies. We really do have top decile power cost as you do your homework. We're in the middle of closing an acquisition that provides us with a significant top tier pipeline to continue to grow our assets under management, or the megawatts we have under operation. And we are extremely transparent. Every month, by the 10th of the month, we release prior month financial information and operating information. And I do that by location. And I also give you a business update. I come from the private equity business, and I like to treat my public company investors the same way I treat co-investors in my private company investments. I have the information every month, and I like to share it with my investors, and hence you'll see me share it with you. And it's a fair amount of detail. Maybe some say maybe too much detail, but I feel like transparency is really important, especially as we're ramping up a business. I want you to see what's going on every month, how we're doing, how we're meeting some milestones, how a milestone might slip a week or two. It gives you a feel for our business and what we're managing. So one of the things that I release is our revenues by month. So our monthly EcoChain revenues, this is just one part of our business, have been scaling dramatically as we ramp up. And you'll see our cash contribution from that EcoChain business scales up to the point where it's at, depending on a few accounting things, it's at a run rate basis of close to $9 million in cash contribution margin, which is very close to our EBITDA. Now I'll step back and tell you more systematically kind of what we do. I'm just hoping to use that to get your attention and have you focus on really in detail the opportunity. First, I think you'll clearly understand that our ownership in the company and the transparency I told you about are core principles of how we do business. Another core principle is a focus on return on invested capital. That guides our investments, and that guides what we do and how we do it. There are two pieces to our business. There's the EcoChain business, which is the crypto mining business. I think that if a value investor like Berkshire were looking for exposure in the space, they'd look carefully at us. We're capital efficient, we're green, tremendous shareholder alignment, and great cost structure. We have another business, which is our instruments business, that provides mission critical instruments and sensors for the aerospace business. So let me begin by telling you more about the EcoChain business. We really are different than many other quote unquote mining companies in the sector in that we talk to power generators and utilities about providing solutions to their problems. That's very different than many in the mining industry that are running around trying to find cheap PPAs. The main differentiator can be seen by one of the facilities I'll talk about later. It's called Anaconda. We were talking to a utility. They said as a consequence of more renewable energy coming onto the grid, they have instability in a portion of their grid. As a consequence, they sold us 3 acres of land adjacent to their substation. And they said, put 25 megawatts of load on here. In exchange, we'll give you a very good deal. We want you running about 83 to 85% of the time. That helps us stabilize our grid. Some of the things you'll see in the pipeline that we're acquiring with Soluna involve working with a wind energy farm that has curtailed energy, meaning it's generating energy it can't sell, or it can sell at de minimis pricing. We get behind the meter and work with them to basically where they can sell every megawatt. And so now we've solved their problem. We've taken marginal renewable energy projects and turned them into money makers. And it's our point of view that nearly every renewable energy project just a few years from now is going to have some sort of computing component with it to help smooth the intermittent energy generation from renewable energy. So this way, renewable energy gets on the grid. It's not such a big problem for the grid manager or utility to manage because all the spikes and intermittency is absorbed by a resident computing solution. So what makes us special? I told you about return on invested capital. And I think that we actively manage our capital deployment because there are 2 competing elements when we look at how we deploy our capital. First is how much computing power or terahash does our dollar buy? And the other one is power density, meaning how much computing power can we put into each megawatt? They're competing. So we tend to favor buying more computing power per dollar and not maximizing our density, because maximizing our density means we're probably buying the cutting edge chip, which I can get the same computing power for almost a 50% discount if I buy 1 generation back. That's really important to us. And when the next generation comes out, like for example, when S19s are the current cutting edge, if the next version of that comes out and companies start selling off their S19s, we'll buy those. Our data centers, to allow this strategy, are engineered agnostically. We can take any processor from GPUs to different ASICs. That allows us to swap out equipment at any time. So in a way, you can look at us managing our equipment portfolio like, and I think this audience will appreciate this, like a value-oriented hedge fund. We see where the value is, and sometimes something's overvalued. We'll sell that piece of equipment like we did in our pilot mine at TNT, and we'll buy equipment that we think will get us a better return on invested capital. And as I mentioned, Soluna's pipeline is 300 megawatts of 100% renewable powered capacity, and we established a real cutoff of 2.5 cents per kilowatt or under is really important to us for our pipeline. That low power cost helps us do something really important. As I mentioned, as a consequence of low power costs, we're able to buy 2nd and 3rd generation equipment and make that economical. But the most important thing is, in the last crypto winter, which was 2018, 2019, at that power cost, we would have still been profitable. And that's where that cutoff comes from. So let me introduce you to our facilities. The TNT facility, which I mentioned a little earlier, is 2.6 megawatts in Washington State. That was our first facility, really a pilot facility. Anaconda is a 25 megawatt facility that I mentioned that we bought the 3 acres from the utility. If you go on our website, you'll see a live webcam to that construction site. Late this month, and I believe on Monday, the utility will be flipping on the first 6 megawatts, and then we'll be rolling into powering that 25 megawatt site up probably through October and early November. Python is a site we've in the process of acquiring and now manage, also in the same state in Kentucky. And that's a facility that was originally a hosting facility that we bought and took control of. And as their hosting clients roll off, we're able to plug in our chips. Just a quick update. This I put out just recently. We're probably going to increase some petahash. You'll see in September in TNT. We just moved around some equipment. Here's a link for the website where you can take a look at us ramping at Anaconda. And at Python, the situation is a little more complicated than I let on the prior slide. The seller is allowing us to manage the entire facility under contract. So the economics are the same to us as if we had bought them until we finish working out how to split the meter with the utility and just the logistics of how to do that. So we're placing our own equipment there and managing other people's equipment, which is his clients. In August, we hit certain key milestones. Also during the I want to highlight during the called Great China Unplugging. There was a fair amount of desperation in the marketplace. We took advantage of that. We cut a hosting JV for 10 megawatts that has a 1-year payback. And I'll demonstrate that here. Let me just flip to here. It's the easiest thing. So over the next 4 to 6 months at Python, we're going to plug in 10 megawatts for our quote unquote customer. And if you take a look at, we roughly spent 2.5 million in infrastructure, about 250,000 per megawatt. If you look at the profitability of that contract, within 12 months, we will have earned 2.5 million or 100% paid for in 1 year the cost of our infrastructure. I'll tell you not to get too excited about this because that was sort of one-time pricing. The market has normalized at a lower level and a level of pricing that we're not interested in right now in terms of hosting other clients. But should there be more desperation out of China, we will, of course, continue to consider opportunistically other types of relationships like this. This slide I want to spend a little bit of time on. This slide I put out last May. It was before, it was as the Python deal was getting done and before Anaconda came up and was done with construction. I wanted to give investors an idea of what our earnings power was once these things come on board. So if you do the math, we sell all our Bitcoin every day and all our altcoin, we sell everything every day. So we convert everything to cash. And so roughly the world has been not quite 45, but over this time span, call it in the 40 zone. So this is the cash contribution margin from ecosystem. Oops, so let me go back there. So we hit this number in Q2 and in Q3, I'm not gonna read any tea leaves for you, but if you just do the math of adding 748 to 358 and then sort of run rating the 748, you get pretty damn close to this 2 million number. That's not exactly exposing any material non-public information. Simple addition and subtraction will get you there. So basically, we are coming close to running, depending on how we scale up and depending on chip deliveries over the course of Q4, we are powering up and putting chips into 50 megawatts, which by the time we're done, roll that forward to Q1 2022, will provide us with this level, call it 22 to 40 million of cash contribution or very close to EBITDA in our business. The market is slowly responding, I think. That's why we release monthlies, and you will observe our ramp as we move to this level of profitability. So I flashed to this forward. This is part of the monthly numbers we release. I'll focus you on this 358, which is our cash contribution for July, 748 cash contribution from August. This is, I'm not going to review this, but these are some operating metrics. You'll see we barely deployed. You'll see in August, we had only 4 megawatts deployed. That's going to be 50 by, call it, December, January. I want to spend a little time on this. We release this every quarter. We're very focused on return on invested capital. So on the TNT mine, which mind you was not large, by Q2 2021, which is a year into the project, we returned all capital. 18 months in, by the end of the year, we will have returned 2 times our capital. We track how much we spend in a site and how much cash it generates. That's vital to us. And we do it graphically so investors can easily understand where we are. This is the TNT numbers, which you'll see continue to be stable and improving, and depending on Bitcoin pricing. As I mentioned before, we are increasing just a little bit the hash rate we put in there in September. These are Python's numbers, which you're seeing scale as well. And these are their operating metrics. Let me spend a few minutes on the instruments business. As I've shared with investors, this is not a core asset. It is a great business that's doing really well. And we're systematically looking at options for this business. I expect it, if we do something, to generate a substantial amount of cash, or we might spin it off and combine it with another business. So we're looking at ways to optimize this business as part of our company, because as EcoChain grows, you'll see this business becomes just too small a piece to stay within our family. It's a great business. It, for example, is focused on the aviation business, where you'll see this part over here of a jet engine that rotates. It monitors the rotation and makes sure it rotates perfectly on axis, that front part of the engine. If that gets off axis, you burn too much fuel. Really off axis, there's opportunity for a catastrophic incident. It also provides instrumentation into semiconductor, materials manufacturing, industrial systems, and power plants. The Air Force is a significant client, as well as GE. And I can talk a little bit about the EV business in a moment. But Q1 results were fairly strong, 1.6 in revenue, 1.1 in contribution margin. This is a business that plus or minus every year delivers between 1.5 and 2.5 million in EBITDA. Just to give you some sense of the power of this company's technology, I will highlight the EV part of the business. So electric vehicles really depend on battery technology. As we need more battery density, there are battery cells. The separators between the cells become critical. The thinner they are, the higher the battery density. But if they're too thin or off spec, you end up with a catastrophic battery issue. So 3 manufacturers out of Asia have contacted us for pilot, pilot installations is what they really are, where we've installed our equipment in their facilities to help them manufacture that divider between the cells exactly to spec and measure that thickness and help them maintain that thickness. I believe that before the end of the year, we're likely to get a production order. And what's interesting is that we didn't market to that sector. They came to us because they understood that our company had a solution. Without getting into too much detail, the whole AI big data in manufacturing really relies on sensors in every part of the manufacturing process to gather data. This company is a big part of that by putting sensors throughout a manufacturing process. So just to close, we've got new products rolling out in sensors and aviation. The business continues to build backlog, and its growth is accelerating through this year, and they're expecting a really exciting next year. So with that, Ian, Mike, I'm done. I noticed that I've got 12 things in Q&A, so I am yours to the extent that we have time to do that.
Thanks, Michael. The first question that I'd like to give you is regarding your capacity expansion. How do you think about the CapEx required for that?
How do I think about it? I think about it every day, not to be flip. It's important, and we're seeking to optimize that. We just recently did a preferred issue of, I think on the cover was 18 million. Underwriter is going to exercise the green shoe, which will turn it to a $22 million piece of paper. There are, as I've disclosed before, there are several levers that we're looking to press on to finance this growth. First is equipment finance on a project level. So we're not looking to maximize our drawdown, our loan to value there, but I'm looking at single digit sort of interest rates. That's point one. Point two, Soluna has already struck agreements with one very well-known infrastructure venture capital firm that has committed to investing equity in these projects, where it gets a 15% IRR, and then we go 50-50 thereafter. So by combining equipment finance and other creative things, we are looking to minimize any potential dilution to our common shareholder base. We are very much aligned with that. And I think what I'm going to do is I'm actively working on this financing plan. That's front and center on my desk right now. It's a puzzle I need to put together, especially if you pay attention inside Soluna. I said there were 300 megawatts. There's probably 150 megawatts that are ready to build. We need to figure out how to finance that. When I figure that out, I'm going to introduce to the marketplace the IRRs on that project, which are very significant, as well as the financing plan. So our investors can consider the cost of capital and compare that to the expected return on our investment. And then the beautiful thing is that we expose to our investors profitability by location. So we're going to put out the range of our expectations. We're going to spend the capital, and investors will be able to track month by month how we're doing relative to the information we put out.
Okay, the next question is, you mentioned earlier that you convert the Bitcoin to cash pretty much immediately. Would you ever consider holding that on the balance sheet like other miners?
I don't think so, because I view investors as having a diversified portfolio of investments where they can optimize risk return based on the securities in which they invest in. So by me investing in Bitcoin, that's muddling their ability to customize their portfolio. So we're very good at deploying capital, very good at technology, and good at the operations end of this. If somebody would like to own Bitcoin, they can open a Coinbase account and own as much Bitcoin as they like. And then they're free to increase and decrease their Bitcoin holding. So let's just say I chose to over time keep 10, 20, 30, $100 million in Bitcoin on my balance sheet. And then an investor says, oh, geez, I like this company, but I wish they were, had half as much Bitcoin exposure. They can't do that. So if on a pro rata basis, they hold some in Coinbase and hold some, of our equity, and they want to go a little lighter on the coin itself, they can. I give them the flexibility. So it's a tremendous benefit in my mind that we don't hold any Bitcoin, because we're allowing investors to have a very flexible approach to their portfolio. We're not locking them in to a certain Bitcoin investment.
Okay, one of the listeners indicated a concern about the tremendous, as I said, the tremendous amount of Bitcoin projects under development, and they're kind of concerned about, if the industry overdevelops, what does that mean to your business, and maybe how would you handle that?
That's something we think about every day, and the way that's expressed is in network difficulty. And the biggest safeguard we have on that is to make sure that our power cost is amongst the best in the business. It's a concern. In our projections, we don't assume that network difficulty is flat. We assume actually a pretty aggressive ramp, and I'll share with you my point of view in that I'm assuming difficulty was scaling up. The China problem happened, it all went down, and now it's starting to scale up again. I think before between March and June of next year, we'll be ahead of the prior peak of where we were. That equipment that was in China will find a home elsewhere in the world. We believe that there are gigawatts of projects being developed, and I don't want to give you too long an answer, but we believe when we look at equipment, we believe in looking at payback period. And so the industry payback period is the way it talks about equipment is it says it just takes, and it's good in that it establishes a common communications method that you just take the cash generated today at today's difficulty level, and how long would it take you to get your money back? So that's not a true projection, because the difficulty level is obviously increasing and the price is uncertain. But you say, okay, I've got equipment, the cutting edge equipment is 8 to 9 months payback, which in the real world is probably 14 to 16 months. A generation back is, call it 3 to 5 months payback, which means in the real world, it's closer to 8 or 9 months. So here's what I can tell you. I can plus or minus know network difficulty a month from now, maybe even 2 months from now, but a year from now, I have no idea. So the longer a bet I make on my network difficulty projection, meaning by buying cutting edge equipment, the greater risk I'm taking, which is why I like buying one generation back, having a shorter payback period, because that just means that I'm living within a time period I can more easily project. And then if in fact you're correct, and we're both correct in that, the network difficulty and capacity really comes online, well, then chip pricing is going to have to drop. So when I look to refresh, I'm not going to pay the wrong number for my chips. So that's really a long-winded answer as to how we're managing that issue.
Okay, the next question, how do you look at hosting joint ventures going forward? Is that a big part of the business plan going forward?
No, it's not part of the business plan, because to be good at hosting, it's like anything else. You have to build up an infrastructure to deal with customers and to deal with issues. Here it's just one customer, 10 megawatts. It was very opportunistic. So my point of view is we will look at it opportunistically and strategically. So I'll give you an example of a strategic thing that has come up. One chip supplier has told us, hey, we see you've got a lot of capacity. We'd like to get a little bit into the hosting business. So how about you host some chips for us? And we said, oh, great, we'll host some chips for you. But what do we get in return? Not just money. We want certain other non-monetary things, better pricing, access to the latest technology and things like that. So we might use our capacity from a strategic perspective and just take, quote unquote, a market price for hosting as opposed to just, doing a one-off opportunistically. So we look at it, but it's either got to be economically incredibly compelling or provide us with some sort of strategic benefit. So that's how we look at that.
Are there margin sustainability issues outside of the Bitcoin price, and how long is your power cost locked in for?
We are subject to, it's different by different location. And so we have agreements with utilities. They're not fixed price PPAs. They're off certain rate cards. And actually, the rate cards have had a history of declining. And I don't expect increases. If anything, I expect, slight decreases over time. But we don't have in the system right now a locked-in PPA. Even the projects under development do have some flex to them. So, what I'd like to do is, that's a very good question. And probably over the next 6 months, I will expose in more detail the types of economic arrangements we have at each site so shareholders can better understand that. So I've given you the best answer I can right now, but I will share more detail because I think it's important for investors to know, actually. So thank you.
So the next question is, what is the ROIC that you're underwriting to in a base case in the first 150 megawatts you're targeting? And how much of that capital that you need we need to get those 150 megawatts operating has already been raised?
That's a good question. I've answered that to the extent I can in a prior answer, and then I've given you an understanding as to the levers that we're pressing. I will release information by that location, which will tell you exactly that answer. So I have a version of that answer on my desk. It's not done. We're working on it. And when it's completed, I'll put it out to the marketplace so you understand 100%. But we are working on that, and I will release it once it's complete.
Soluna's website talks about using the data centers for other batchable computing. What is the expected profitability of that relative to crypto mining?
Actually significantly higher. And I began to explain to the marketplace. The marketplace didn't really grab onto that. So I figured, you know what, over the next year, we'll start to ramp that up quietly, start to get some revenue. And when the revenue and profitability of that line of business become obvious, I'll begin to disclose it and talk to investors about it. But I will talk more about it as we turn it into something. It is definitely something we're doing because we view these distributed batchable computing centers as absolutely critical. And we're looking to optimize our revenue and profits in each data center, and doing, outsourced burst computing, sort of AI, and just any kind of dense computing application is, at least right now, more profitable than crypto mining. So we're slowly ramping, and I will post people as we do it. It is a lucrative business.
What percentage of your mining operations are clean energy, and maybe how does that evolve?
First, we will score ourselves on ESG, if not by the fourth quarter, then the first quarter. Nearly everything, I'll go by location. The two currently under, Python and Anaconda, we will, I don't know the right way to express it, because the TVA supplies most of the power, and we can get assurance from them that the power that we are getting is mostly off of hydro, and to the extent that it isn't, we can pay them a small premium to be sure that it is. We're talking to them about that. So very green, but the Soluna pipeline is even greener in that we're not even on grid. We're hooked up to a wind farm. So that is as green as it's going to get. So we're cognizant of it. It's renewable. We have a corporate focus on, we have no plans to do natural gas, which we view as gray, not necessarily, black like coal, but we're focused on renewable. So that's where we are. And you'll see us give you a report card on that. But just, I want to assure you that we are, hold ourselves to a very high standard. So we are very green oriented, renewable. The Anaconda and Python is mostly hydro through the TVA.
Okay. The last question, I believe. In your view, why does MKTY trade at such a drastic discount relative to peers across all relevant metrics?
It's very simple. I'm telling the marketplace what I'm going to do. Some people might believe me. Some people might not. Some people might say, this guy's talking a big game. He's not going to energize 50 megawatts. Okay, if I don't, then I'm overvalued. But that's why I give you numbers every month so you can watch as we hit milestone after milestone and energize 50 megawatts and put compute in it and generate a lot of cash. So I think I love this as my last question, because that disconnect is not going to be sustained, because I will release monthly numbers every month between now and January that scale. So now I'm asking people to believe that we will scale. By January, we will have scale. And by then you'll pay full price.
I think that's a good place to end it.
I'm in agreement with you, Ian.
Yeah. Thank you for your time and going through the story and answering all those questions. You have a lot of big fans of MicroCapClub, and we appreciate your involvement in the event.